Hi, this is Jack Crooks from Money and Markets TV. It's not every day that I see a clear opportunity for enormous profits in the currency markets, but that's exactly what I'm seeing right now in the US dollar Japanese yen trade. Lately, the yen has been inversely correlated with the risk-on, risk-off nature of the markets. In other words, when investors grow more confident, they pile into risk assets like stocks, and the US dollar goes up in relation to the Japanese yen. When investors pull their money out of the markets, stocks go down, and so does the greenback. When the red line on this chart is falling, it means the yen is appreciating against the dollar. There's a good reason for this relationship. When things get ugly and investors exit assets like stocks, in other words, risk off, Japanese insurance and pension funds repatriate or bring their money back home and put it in local Japanese government bonds. That's why weakness in stocks has meant strength in the yen recently. But this isn't always the case. For example, just look at the same chart over a longer duration, about 5 years. From its peak in late 2007, the Dow has fallen about 15%. But during roughly the same time period, the yen has jumped nearly 36% against the dollar. The stronger yen has presented a real challenge for Japan, which is struggling along with the rest of the global economy. Japan is still reliant on exports for much of its economic growth, and a stronger yen makes those exports less competitive to international buyers. At the same time, Japan's debt and deficits are skyrocketing. This year, the country will run a fiscal deficit of an estimated 10% of GDP. And the International Monetary Fund says Japan's debt to GDP ratio could rise to a whopping 241%, roughly double that of Italy. Yet despite these scary numbers, Japanese interest rates have stayed extremely low. The yield on the 10-year government bond is below 0.9%. But eventually, bond investors will turn their attention from Europe to Japan, and the country's borrowing costs will begin to reflect real or even potential funding risk. When that happens, local demand from Japanese institutions will fall further, putting even greater pressure on interest rates. And the slowdown in economic activity will further reduce Japan's available pool of savings to fund this growing need. It's truly a nightmare scenario, and sooner or later, the yen will begin to reflect these internal realities. I think it will be sooner. At that point, the yen will begin to fall against the dollar, and it will keep on falling very hard for a very long time. If you take a core long position on the US dollar against the Japanese yen, your profit potential could be enormous. I'm Jack Crooks from Money and Markets TV. Thanks for watching.